So now that you're making money with your real estate investment, how do you protect that capital and not pay taxes? So Nathan, I know you guys at Hall CPA have a ton of different tax strategies and investment strategies that investors can take advantage of. So talk me through how we can ultimately protect those profits that we've made with our real estate investment.
Yeah, absolutely. So one of the biggest things that you get already is depreciation, right? So you get depreciation that helps you protect your cash flow. A lot of times real estate investors never are basically during the operations of their property are never taxed. And why is that? Because they have all the deductions to operate it, plus you have the non-cash deduction, the special non-cash deduction, the paper deduction per se, that is depreciation. So a lot of folks, like, basically that's the biggest hack, right? At the end of the day with real estate is that you're never going to get taxed on your cash flow for the most part, right? There's always special caveats. Hey, if you're crushing it out there, fantastic. Guess what? We do have a strategy to help you do that. And that's with cost segregation studies. Cost segregation studies help us accelerate depreciation into the current year where you claim and perform the cost segregation study. And by doing that, you forward a ton of depreciation into the present tax year. And now you've got a ton of losses through bonus depreciation or even 179 deductions as well. And crossing fingers on 100% bonus coming back here pretty soon. But in the meantime, this cost segregation study is still an amazing hack and allows us to take a lot more depreciation up front versus having to wait over the standard 39 years that we normally would be stuck with in that vein. So that's an easy one for us to be able to take advantage of that. Now, the next question is, okay, great. So now but what if I want those losses to offset my W-2 income? I wanted to offset my other business income that I have going on. How do I do that? And so that's where the short-term rental loophole strategy, whatever you want to call it, comes into play. And so essentially what this means is now, just today I went over with another short-term rental investor to prove this strategy out and represent them and show them how it's possible. Because a lot of IRS agents don't understand this strategy and you don't even know about it. So what this is, if your short-term rental has an average stay of less than 7 days, then you're going to be able to use all those losses against your W-2 income. Now, the other caveat is that you're going to have to spend at least 100 hours in the short-term rental to qualify. Now, if you don't, then we're kind of getting to a tough battle where we may or may not be able to qualify. But if you spend 100 hours, do a cost segregation study, you're going to have significant tax losses to offset against your business and active income.
That's awesome. Now, do I have to be like a real estate professional to do this, or can just a regular, guy do this? What designations do I need to pull this off?
Yeah, essentially, the only thing you need to do is ensure that your property has an average of 7 days or less, which sounds just like a normal vacation
short-term rental,
right? On Airbnb, it sounds just like it, right? Yeah. So normally this caveat was more for hotels once upon a time, but in the era of short-term rentals and Airbnbs, that's a fantastic strategy. So now when you do this, all the improvements you make, all the pool you put in, the hot tub, all of that stuff, you can expense that with bonus depreciation or 179 and use those deductions to help you save on your tax return versus depreciating that over a long period of time. So you get to take those losses, and with the time value of money, means you get more capital today, which is more important and better for you versus getting the capital over a lifetime of savings, right? 39 years is a long time. And so if we can get more of those deductions today, so you have more capital and are able to take more losses and are able to use that capital to fund another short-term rental, to pay down your house faster, whatever you want to use that cash for. And it's your choice, and now you can make the investments in the way that you want to. So that's how the short-term rental loophole operates and works, and it's a fantastic strategy that literally anyone can implement.
I love it. Yeah, a dollar saved today is worth $2 tomorrow, as the old saying goes. So, guys, if you want to take advantage of some of these strategies, again, go to therealestatecpa.com. Feel free to book a call and talk with the team.